on people who use most of their income to buy essentials like food, housing, and transportation, where, I mean, we've all seen charts that show if you're a middle-income person, you've got room to absorb some inflation. If you're at the lower end of the income spectrum, it's very hard because you're spending most of your money already on necessities, and the price is going up. So, but it's punishing for everyone. So it has been a difficult time for the economy, but we do anticipate that inflation will move back down, as I mentioned earlier. It may take longer than we like, but I'm confident that we'll use our tools to bring inflation down. And you ask about rates. So the way that works, I would explain, is as we raise interest rates, that should gradually slow down demand for the interest-sensitive parts of the economy. And so what we would see is demand slowing down, but just enough so that it's better matched with supply, and that will bring inflation down over time. That's our plan.
Thank you. Let's go to Jolene Kent at NBC News.
Hi, Chair Powell. Thank you so much for taking my question, doing this today. My question is a follow-up to what Brian just asked. What is your message to consumers out there who can no longer afford the basics due to this high inflation?
Well, that is, yes, indeed. I mean, as I just said, you know, I think we do understand very much, and we very much take to heart that it's our obligation to restore price stability. And you know, we've had price stability for a very long time and maybe come to take it for granted. But now we see the pain. I'm old enough to remember what very high inflation was like. And, you know, we're strongly committed as a committee to not allowing this higher inflation to become entrenched and to use our tools to bring inflation back down to more normal levels, which our target is 2% inflation. So we will do that. And I just would want people to understand that. But the way we do that is by raising interest rates and by shrinking our balance sheet. And so financial conditions will become, at the margin, less supportive of various kinds of economic activity. That will slow the economy while also allowing the labor market to remain very strong. And, you know, the good news is the economy and the labor market are quite strong. And that means the economy, we think, can handle interest rate increases.
And as a quick follow-up to that, you know, obviously the Federal Reserve walking this very complicated fine line, trying to avoid a recession. For the consumers out there who are worried about their jobs in a possible recession, what do you say to that?
Well, I say that our intention is to bring inflation back down to 2% while still sustaining a strong labor market, and that the economy is very strong. If you look at where forecasts are, people are forecasting growth that's strong within the context of U.S. potential economic output. And we expect that to continue. And to the extent the data come in different, then of course our policy will adapt. But we do believe that our policy is the appropriate one for this forecast, and we believe that we can bring down inflation. We believe that we can do so while sustaining a strong labor market. The labor market it's not strong in the ordinary sense of the word. We have not seen a labor market where there are 1.7 job openings for every unemployed person, or where if you add job openings to those who are employed, that's actually substantially a larger number than the size of the workforce, than the number of people who actually count themselves as in the workforce. So this is a situation where demand is higher than supply, and when that happens, prices go up. And so we need to use our tools to move supply and demand back. And we don't think we need to do this alone. There will be other factors helping that happen, but we certainly are prepared to use our tools, and we will.
Thank you.
Thank you. Let's go to Simon at The Economist.
Thank you, Michelle. Thank you, Chair Powell. Sorry to take you away from inflation for 1 minute. May I ask about the sanctions on Russia, and specifically the freezing of the central bank assets? Of course, that raises a similar risk for other sovereigns around the world and their biggest companies potentially. Any concerns about, in the long term, how this might affect the dollar's status as the preeminent global reserve currency? And in the past couple of weeks, have you had to deliver any kinds of reassurance to other central bankers around the world?
Well, so of course, central bankers around the world are generally very in favor of all of these sanctions. But let me say this: sanctions are really the business of the elected government, and that's true everywhere. So, the administration and the Treasury Department in particular, and other agencies, they create these sanctions. We're there to provide technical expertise, but they're not. It's not our decisions, so I'm reluctant to comment on sanctions really much because again they're not for us. We have a very specific mandate, and these are really the province of elected governments, as I mentioned. So I'd have to leave it at that. So, sorry.
Thank you. Let's go to Nancy Marshall-Genzer at Marketplace.
Hi, Chair Powell. Thanks for taking the question. You've been talking a lot about rising wages, which on the one hand is a great thing, but are we possibly seeing the beginning of a wage price spiral?
So the way I would say it is this: we first of all, I would agree with the premise that wages moving up is a great thing. You know, that's how the standard of living rises over time, and generally it's driven over long periods by rising productivity. But what we have now, if you look at these the wage increases that we have, we look at we're blessed with a range of measures of wages that all measure different things. But right now they're all showing the same thing, which is that the increases, not the levels, but the increases are running at levels that are well above what would be consistent with 2% inflation, our goal, over time. And that may be, we don't know how persistent that phenomenon will be. It's very hard to say. And that's really, I think, the sense of your question about a wage price spiral is that something that's going to start happening and become entrenched in the system? We don't see that. You can see, for example, in some sectors that got very high wage increases early on, those wage increases look like they may have slowed down to a normal level. But it comes back to, you know, what I'm saying here, which is there's a misalignment of demand and supply, particularly in the labor market, and that is leading to wages moving up at ways they're not consistent with 2% inflation over time. And so we need to use our tools to guide inflation back down to 2%. And that would be in the context of an extraordinarily strong labor market. We think this labor market can handle, as I mentioned, tighter monetary policy, and the overall economy can as well. But yes, wages are moving up faster than is consistent with 2% inflation. But it's good to see them moving up, but it wouldn't be sustainable over too long of a period to see them moving up that much higher. And that's because of this misalignment between supply and demand. We expect to get more labor supply. We did last time. We got more than we expected during the last cycle. This time we've gotten much less than expected. So it's not easy to predict these things. But we do expect that we'll get people coming back in the labor market, particularly as COVID becomes less and less of a factor in many people's lives, something we all wish. So that's how we think about it.
Thank you. And for the last question, we'll go to Don Lee at the LA Times.
Hi, Chair Powell. I think you said to the Senate earlier this month that in hindsight, the Fed should have moved earlier. And it sounds like today that you don't think that the Fed is late. And I just wanted to get your clarification on that. And if it is, if you still think that the Fed is behind the curve, how much behind the curve is it?
Right. So we are not. We don't have the luxury of 20/20 hindsight in actually implementing real-time decisions in the world. So, the question is, the right question is, did you make the right decisions based on what you knew at the time? But that's not the question I was answering, which is knowing what you know now. So I think if we knew now, of course, if we knew now that these supply blockages really and the inflation resulting from them in collision with very strong demand, if we knew that was what was going to happen, then in hindsight, yes, it would have been appropriate to move earlier. Obviously, it would be, but again, we don't have that luxury, And then, but that's a separate question from your other question, which is behind the curve. And I don't have the luxury of looking at it that way. We have our tools, powerful tools, and the committee is very focused on using them. We're acutely aware of the need to restore price stability while keeping a strong labor market. And what I saw today was a committee that is strongly committed to achieving price stability in particular, and prepared to use our tools to do that. We're not going to let high inflation become entrenched. The costs of that would be too high. And we're not going to wait so long that we have to do that. No one wants to have to really put restrictive monetary policy on in order to get inflation back down. So, frankly, the need is one of getting rates back up to more neutral levels as quickly as we practicably can, and then moving beyond that if that turns out to be appropriate. And as you can see, it is appropriate in the sense to people's SEPs. They do write down levels of interest rates that are above their estimate of the longer run neutral rate. And there's also a range of estimates too, as you will see if you look at the details of the SEP. But thanks for your question.
Okay. Thank you all. Thanks, Mr. Chair.
Thank you.
That wraps up the news conference with Chairman Powell from New York City. Good afternoon to you all. Alongside Tom Keene and Lisa Abramovitz, I'm Jonathan Ferro. This is the Fed Decides. Let's go through this piece by piece, and then we'll touch on the price action. He talked up the strength of this economy, the resilience of this economy, acknowledged that high inflation would be with us at least through the middle of this year. He said that financial conditions will have to become less supportive, get rates back up to neutral, maybe even go through neutral, and balance sheet reduction could come at the next meeting in May. So the bond move looks like this. Makes sense, doesn't it? 2-year yields are higher. On a 10-year, we're up by, where are we? Around about 3 basis points to 217. On a 2-year, we back away from 2%, came close to it, 192.97. The curve is flatter, and we rally on the long bond. On the 30, yields are down by 3 basis points. So, you with me? A tighter Fed, tighter financial conditions, yields up at the front end, okay. Now take a look at stocks. Up 1.7% on the S&P, on the NASDAQ, up by almost 3 percentage points. TK, can you reconcile what's going on here?
I think it's original territory, to use the cliche. John, what I would really focus on here, and I've never heard this from a Fed official and certainly not from a chairman, I heard the phrase excellent progress, I think 2 times, if not 3 times. To me, that is really, really critical, John. Excellent progress is they want to establish their credibility by a timeline, which is January 26th, on to March 4th, June 15th, and dare I say to after school starts September 21. This is a sequential Fed, as they are now hugely data dependent.
And this Fed, Lisa, gearing up to make potentially some big moves this year.
Honestly, we learned so much in this press conference, including that next meeting in May, they may start shrinking the balance sheet. He's talked about how perhaps that would be equal to 1 rate hike. That's unclear. Of course, Deutsche Bank came out and said that their estimate for how much the balance sheet would shrink would be more like 3 or 4 rate hikes. But honestly, to me, it is fascinating to see that the message from the bond market with the inversion of the 5 to 10s aspect, the 7 to 10s aspect, is sending a very different message than what we're seeing in the stock market.
Did you get the feeling in that news conference that he wanted to talk a little bit more about balance sheet reduction, but maybe wasn't given the opportunity too many times, Lisa?
You're saying a lot of people didn't ask.
He seemed very happy about getting the first question on it.
He, I think, wanted to get a sense that they had made a lot of progress on this. That's what he said. He said that they will have more details, and then when asked further, he said, read about it in the minutes. They'll have much more detail there.
Looking ahead to the minutes, let's get to Mike McKee. Mike McKee, some audio problems, so I understand on your end you didn't actually hear the whole news conference because many of the reporters couldn't hear his responses to their questions. Can you give me your best take and your takeaway?
Well, we fortunately have some very talented people behind the scenes here who were sending me transcripts as we went along. The Fed chair obviously struggling to make a case that the Fed is not behind the curve and does not have to worry about inflation getting out of control, but we have to move as much as possible and perhaps go more than neutral because inflation is too high. It was sort of a circular argument. The Fed is anticipating tight policy in 2023 and 2024, restrictive policy, and yet unemployment's not going to go up at all. And I think he was asked by one person, if you're not seeing wage price spirals and you're not going to be raising unemployment, then where do you get the reduction in demand from? And he seemed to have a little trouble answering that. It's a political problem for the Fed at this point because they can't get too tough in public, and they don't want to go all Paul Volcker, to reference my question, because they don't want to diminish confidence in the economy. But at the same time, they want the markets to think they'll do what's necessary.
Mike, I want to talk about the dispersion of the dot plots. Ellen Zentner and her team, with a piercing note, says, look, what really matters here is the spread, the indecision that's out there for 2023 dot plots. Is anybody on the same page at this Fed?
Yeah, I mean, there are people who are in roughly the same area, but the whole issue of the out years for dot plots is always the same because nobody can forecast that far out. It's never been clear why they actually do a dot plot that far out. I think you can take 2022 dots as a best case scenario for what the Fed is thinking it's going to do. But after that, the picture gets really fuzzy. Does the war last? Does inflation not start to come back down as we anticipate? Do wage increases start to get embedded? The Fed has no idea. So you really can't put any money on what the longer term dots are saying.
Yeah, I do wonder about how consistent some of the comments he said were with previous comments, including price stability is an essential goal. It is a precondition for achieving the kind of labor markets we want, which is strong and sustained labor market. You really can't have maximum employment for any sustained period without price stability. Is this basically throwing out the dual mandate and saying inflation is number one?
Well, you know, the Fed went through this with Alan Greenspan when they went into the idea that keeping inflation down was their major goal. And that was about 10 years worth till we got to the great financial crisis. So this is sort of back to the future for the Fed. And it is a long time accepted way of looking at the economy for them. It's not really so much getting rid of the dual mandate, but saying that inflation has primary position in achieving the dual mandate.
Mike McKee, thank you, sir. Live on TV and radio, if you're just tuning in, you missed the last couple of hours. We've had the 25 basis point hike from the Federal Reserve, the first since 2018. There was some dissent. One vote looking for a 50 basis point hike. That was the St. Louis Fed President, Jim Bullard. In the forecast, they raised their inflation outlook. They dropped their growth outlook. They kept their unemployment rate at 3.5% for 22 and for 2023 as well. On the outlook, we're going to get some more rate hikes. The dot plot looks like this. At the end of 2022, they ended about 1.9%. At the end of 2023, they end at about 2.8%. On the frequency and the size of each move, take a listen to what the chairman had to say in the news conference.
Every meeting is a live meeting, and we're going to be looking at evolving conditions. And if we do conclude that it would be appropriate to move more quickly to remove accommodation, then we'll do so. I can't be perfectly specific about it, but that's certainly a possibility as we go through the year.
Tom Keene, he can't be perfectly specific, but it's certainly a possibility they might have to go quicker.
Well, we're going to make excellent progress here, John, and talk to someone about the heart of the matter and part of the mandate of this Federal Reserve. Away from yield, away from markets, it's about labor. David Blanchflower owns this. Can't say enough about it at Dartmouth College, and we're thrilled that Professor Blanchflower could join us this morning. Danny Blanchflower, what I find fascinating, and I have never, ever heard it from a central bank, is we're making excellent progress. This is a Fed that, to maintain credibility, wants to go from meeting to meeting, making it up. What is their method of making excellent progress?
Well, I think their method is to have lots of wishful thinking and hope that this all turns out right. I think the big one that I was struck by, and I just heard John talk about it, I mean, the assumption here is that these rate rises and the talk of rate rises are going to have an effect on inflation, and they're going to have no effect on the real economy at all. And I don't buy that one tiny bit. This strikes me as what happened between 2015 and 2018 when they kept saying the labor market is tight. when it actually wasn't. And you have this contradiction between Wall Street and Main Street. And I think it's really, in a sense, it's data dependent, and they better be right, and their wishful thinking better be appropriate. But I'm very struck by the phrase, the labour market is extremely tight. And he talked about the mandate is about maximum employment. It's not about the unemployment rate, it's about maximum employment. Today, the employment rate is 5 percentage points below what it was in 2000. Every other Western country, it's above that. So we're 5 percentage points below, with 1.2 percentage points below where we were in February 2008. So lots of people have been pushed out of this labour market, and they've been pushed. And basically, if the labour market was tight, they wouldn't be out there.
Hello, traders again. I'm going to place stop for Bitcoin, and I'm going to place 0.5% from the price we purchased. We purchased for 40,280, and the 0.5% for this price will be 40,482. Okay, so please place your stop for Bitcoin. If you followed my trade, if you copy them, and in this case, you will not lose any money at all. Okay, let me change the color basically, and people will realize, people who follow the trades and cannot sit in front of screen all day, they can see that this is where we place stop for our position. Okay, that's it. That's it. This is how you trade. This is how you day trade. As you can see, we purchased at 11 o'clock, and almost a day we was holding this position. I thought that it will move higher, so I would move my stop higher, but over the day it moves higher, then lower, so I decided not to hold overnight, and I decided to close this position at this level if it will break this level down. Okay, stay safe, guys. I'll speak to you later. And if you want to get a strategy, please go to company.co.uk. Okay, and you can purchase the strategy from our website. Stay safe, guys.
The economy is not anywhere near where it was, and that's been the fundamental error that the Fed has had and Powell has had. 2015 and 8 to 18, he got it wrong. I think it has it wrong again. Inflation isn't embedded. The expectations are not embedded. There's no likelihood of it. What will happen is this will hurt real people.
Danny, what's interesting about this today, this afternoon, we understand your disagreement with the Fed on inflation. This is about the labour market now. That's where you're a true expert. Chairman Powell keeps talking about how strong the economy is, how strong the labour market is. His words, we do feel the economy is very strong and well positioned to withstand tighter monetary policy. So let's take his words and go through the forecast together,
exactly
Danny. Because not everyone's had a chance to go through the forecast yet, so I'll read them out. The change to GDP, a cut to 2.8% for 22, down from 4%. If you look at inflation, they kick that high to 4.3%. The December projection, 2.6. Now, this is what you're getting at, Danny. 3.5% is the unemployment rate for 22. For 23, it's 3.5. And for 24, it's 3.6. And Danny, let me just add one further thing. Can they take rates to where the dot plot is, at 1.9% in 22 and 2.8% in 23, and maintain an unemployment rate of 3.5% through 22, through 23?
No, of course not. But of course, the starting point, and I've been writing about, as lots of others have, is the unemployment rate is no longer a decent indicator of things, but it's going to rise. But the other ones are the participation rate and the employment rate. And the question you have to ask is, what's going to happen to that? Do you really think that a tightening cycle is not going to have any effect on the real economy? You're right. You've said it here. The chart has got it completely right. And I think of it as cloud cuckoo land. You're raising the price of borrowing. You're tightening monetary policy. Fiscal policy is tightening back. You're thinking of tightening the balance sheet. And so the problem that Powell is going to have is that he's going to be confronted by some horrible bits of data, particularly on consumer expectations, which I've written about. I was just looking today at the University of Michigan consumer expectation numbers for the latest we have.
Decade
lows. Completely indicative of recession.
Danny, they've not been pretty at all. Cool. You're on the same page with Dan Swunk and Scott Minard as well on this inflation, unemployment, growth forecast. Danny, we've got to leave it there, Danny. It's always great to catch up. TK, that 3.5% projection on unemployment, we're hearing a lot of people call these forecasts fantasy land this afternoon.
Peter Bookvar was heated about it. He said it's magic. He said the inflation trend is modeled. It seemed to be on the edge of magic. I don't have the exact language in front of me as we have a publishing marathon going on right now. John, we got a comment on the Dow up 300, SPX up 1.6%, 66. Any Fed chairman, that's what they want, isn't it?
Hey, it's not bad, is it? We're higher off the back of this. I've got no idea why. You ask Alan Ruskin, Tom, of Deutsche Bank, why the dollar's weaker this afternoon.
Well, we're going to start with that. Alan Ruskin joining us right now as we started with his colleague, Matt Lazzetti. It seems good time ago. Alan, do you have a dollar call all for this? If the dollar is the deepest market, can you adjust and amend a dollar call this afternoon?
I wouldn't say so, Tom. I think what you've seen is a substantial catch-up by the Fed, and then the market effectively pricing in very similar numbers to the Fed's dots. You know, if you look at Fed fund futures, it's very close to where the Fed's dots are for 2022 and 2023, at least the median dots. Right. So, you know, there's no big surprises implicit within the Fed expectations side to drive the dollar. I think we're going to go back very closely to watching war headlines.
And Alan, what's so important, and folks, I want to point out an hour ago, the war headlines are good. The mayor that was captured has been freed, and we'll get to that later today with Bloomberg. Alan Ruskin, I want to go to ages and ages ago when you and I remember the secretiveness of the central banks. Do we have too much information on this Wednesday?
Sometimes I think so, Tom. I mean, I think, you know, your previous guests were talking about cloud cuckoo land and wishful thinking, etc. And, you know, when you look at some of this information, and you certainly to get anything close to, you know, what you get from the SEP data, from the projections data, in years gone past, right now it feels like the numbers don't really add up. It does look like wishful thinking, and therefore there's a lot of credibility that's at stake. So I think, you know, particularly at points in time when you've got a huge amount of uncertainty, maybe a little bit less information is better. But in the end, I think what the Fed's revealing is they are very much human.
Alan, the stock market is rallying. We're getting a very different message from bonds. You're seeing yield curves flattening or even inverting, and that dollar sell-off some people could attribute potentially to a lower prospective growth outlook for the U.S. Is the stock market completely divorced from the message that's being sent by other asset classes right now?
I would say no. I think obviously the stock market's come off quite substantially. It's responded, I think, to higher bond yields. I wouldn't get too excited by what you're seeing right now in terms of immediate response. As I said, you can get caught between Ukraine headlines and Fed headlines and, you know, easily have a 1.5% move on the S&P. I think the overall message you got from the Federal Reserve today was very clear. They want financial conditions to tighten. Financial conditions, a key component of financial conditions is the stock market. So I think, you know, this backup in yields accompanied with slightly softer equity prices is pretty much as desired. I think the issue there is, of course, can you soft land this thing? Because historically, when the Fed tightens, you do get some hard landing somewhere, really. So, but right now, I think they're pretty comfortable with, you know, where we're at.
Right now, Alan, are you more or less confident in the possibility of a soft landing?
It hasn't really changed. I mean, I think the Fed's getting on side a little bit more to the idea that all things being equal, you are going to go beyond neutral. That neutral, call it 2.5%. You know, you're going to have to go beyond that if you want to weigh down on inflation. I think that's a very reasonable stance, unless you get some exogenous shock that comes out of nowhere, that the cycle is much more mature than you anticipated, in which case the economy will slow down by itself. So there's a lot of uncertainty here.
David, I've got to get ready for tomorrow morning in Bloomberg surveillance. So let me finish with Burkhard Landau, who you have a nodding acquaintance with. He is heated that we will see some form of currency, coordinated, less coordinated depreciation or reappreciation, depending on the pair. Yen out to 118, dollar buttressed higher. Europe in the news, they're fragile. Can you model in some form of intervention as a tool by these central banks?
I don't think as yet, Tom. I think the moves by historic standards are still quite contained. You know, I think were, dollar yen to sort of quickly go above 125. The speed was really there as well. Maybe you could see something between the BOJ and the Fed. I think even that would be a bit of a stretch. I don't think so at this point. If the war really kicked euro down sharply through 105, then, I think they would see that as an undesired exogenous shock as well, and they could intervene. But for the moment, at least, no.
Alan Ruskin at Deutsche Bank. Thank you, buddy. TK, just to remind you, you're not here tomorrow. I know you're gearing up for tomorrow. You're not. You've got tomorrow off and the day after and early next week too. Stand by. You've got 3 more minutes to do with us. Before we get there, Romain Bostic looking ahead to the close. Hello, Romain.
Hey, John, getting ready to count you down to the close. Broader market not far off the highs of the day. Big part of that reason, tech stocks getting a little bit of a bid here. Primarily a lot of those growth names. Remember, you had that one hike today, the 6 more being telegraphed by Jay Powell. That was already priced into this equity market. And of course, the war in Ukraine meant that more dour prospects were being priced into this market. Big part of the reason why you're seeing a little bit of a rebound, particularly when it comes to some of those high valuation names. Microsoft higher by about 1% on the day. The bank stocks getting a pretty decent bid here. Bank of America up about 2.7% right now. To the downside, though, a few losers here. Energy stocks continue under pressure. Chevron down slightly. And Pulte Group and the rest of the home builder space taking a leg down as the prospect of higher rates and how that's going to feed through into the housing market definitely causing some concern. Of course, we still didn't get any real insight, any deep insight here into that balance sheet runoff. That will have a big impact, of course, on some of the home builders going forward. As we count you down to the close, Mira Pandit, JP Morgan Asset Management Global Market Strategist. She's going to be joining us to break down what we learned today at the Fed. Well, now, triple take, a little bit after that. Vince Reinhardt, chief economist over at Dreyfus Mellon, and Stephen Kelly over at Yale, also going to be joining the big program. Tom, I know you're off tomorrow, but stick around. You don't want to miss it.
I remain. Looking forward to it. Thank you, sir. Thank you very much. Looking forward to the close. About 15 minutes away. Tom Keene, May 4th, your next Federal Reserve meeting.
And
April 12th, a CPI print. Just after that May 4th meeting, another CPI print.
You taught me how to use a Bloomberg, and just as you were talking, I looked up, and the jobs report is May 5th. And I'm going to go with Blanche Flower. We're all focused on inflation, financial instruments, the spread this and the spread that. Most of America's focused on the job economy, which is tight, but, and that social, that pandemic but is the key focus here.
Bramo, does Jim Bullard find some friends by the time he gets round to May 4th? Is that going to be the conversation again? Is it going to be 50? Is it going to be 50?
And honestly, right now what you're seeing is the bond market actually pricing in a much greater likelihood of another 50 basis point rate hike at one of the upcoming meetings. I do wonder, though, about this whole idea that lowering inflation is a precondition for a strong labor market. This, to me, is a shift in rhetoric, just a little bit around the edges.
This was a fascinating meeting.
It was.
A fascinating news conference, and pretty much everyone agrees that we've spoken to so far that their forecasts are somewhat wishful thinking. Equities up by 1.6% on the S&P. From New York City for our audience worldwide, good afternoon to you all.
Headlines and breaking news 24 hours a day at Bloomberg.com, the Bloomberg Business app, and at Bloomberg Quick Take. This is a Bloomberg Business Flash.
Yes.
From Bloomberg World Headquarters, I'm Charlie Pellet. 14 minutes to go ahead of the closing bell. With the Dow, the S&P, NASDAQ all advancing. 10-year yield now 2.17%. Stocks gained after Fed Chair Jay Powell struck a more positive tone on the prospects for economic growth as the central bank raised interest rates for the first time since 2018.
The FOMC raised its policy interest rate by 1/4 percentage point. The economy is very strong, and against the backdrop of an extremely tight labor market and high inflation, the committee anticipates that ongoing increases in the target range for the federal funds rate will be appropriate.
Jay Powell reading from the statement at the FOMC meeting today. S&P up 75 right now, up 1.8%. The Dow up 375, up by 1.1%. We do have the S&P close to session highs right now. We've got NASDAQ up by 411 points for the NASDAQ Composite Index, a gain right now of 3.2%. The NASDAQ 100 index is up 3.1%. Russell 2000 up by 2.6%. And Dow Transports rallying now by 4.9%. Again, the 10-year, 2.17%. Spot gold up 0.4%, 19.25 the ounce. A retreat today for West Texas. Intermediate crude oil slipping after a volatile session. Libya is urging OPEC Plus to boost supply faster. WTI down 1.8%, 94.72 a barrel. Brent down now by 2.4%, 97.55 a barrel. So again, recapping, equities move higher. Fed Wednesday with the S&P up now by 1.8%. I'm Charlie Pellet. That is a Bloomberg Business Flash.
I'm driving in my car.
How about you let me drive?
Oh, no. Who's gonna drive you home? Honey, please, I'll do the driving. Drive on. Excuse me, I want to drive. It's the question that drives us.
This is the Drive to the Close.
That funky music will drive us till the dawn.
On Bloomberg Radio.
All right, folks, you just heard our simulcast on TV and radio. Tom Keene, Lisa Abramowitz, and Jonathan Farrow. That Fed meeting, second Fed meeting of the year. We'd all been looking forward to it, and we got that March rate increase as expected. I think what's interesting is what they have talked about in terms of growth. You heard Jay Powell talk about what he thought was the strong growth forecast, but also moving up their inflationary expectations. But longer term, the expectation is inflation comes down again. I've been tracking the markets here, Tim, and Charlie broke down the numbers, but it looks like the equity market, based on my, calculations, and just as the news of the Fed announcement was coming out at 2:15 Wall Street time, we are higher in terms of where stocks were prior to that announcement. So we've definitely seen a bounce back after an initial sell-off. And it looks like that 10-year has settled down to where it was prior to the Fed news. The 2-year, the shorter end of the yield curve, close to where it was, a little bit higher.
Well, let's go back to the equity market, because I think that this was a really important point for at least equity investors when Powell said, quote, "The economy is very strong and well positioned to handle tighter monetary policy." It was at that point that equities started moving higher, according to our Bloomberg Live blog team, when it comes to the what the FOMC chair was saying and what markets were doing, because it was pretty remarkable. As soon as his statement came out, we saw a real sell-off in equities.
Yeah, we did initially, but we've seen the bounce back.
Exactly.
And if you look at the yield curve, we saw the yield curve between 5 and 10 years invert after the FOMC decision, right after it. And the 5 to 30-year yield curve, just a little bit about 30 minutes ago, the curve extends, it's flattening to under 25 basis points. So this is what's key. We're watching that inversion, especially when it comes to 2 and 10, and what it tells us about the potential for a recession. And so, we've talked about that in particular. Right now, though, yields, like we said, kind of staying where they were, the bid up to it, but down from some of the spikes we saw right after that Fed decision.
Okay, so the Fed raising interest rates by a 0.25 percentage point, signaling hikes at all 6 remaining meetings this year, launching a campaign to tackle the fastest inflation in 4 decades. We got the dot plot. The median projection was for the target rate to end 2022 at about 1.9%, kind of in line with bets, but then rise, Carol, to 2.8% in 2023.
Yeah, this is what's kind of interesting. And our live blog on the Fed really pointed this out. They're like, wow, look at that inflation forecast, 4.3% for the end of this year, a major overshoot of the target.
Is that transitory?
That's the question. They still have it coming down to 2.3% in 2024. It's a few years from now, but that's the expectation that it rights itself. And then when it comes to growth, back in the December forecast, they were looking at more like 4% for this year. Now it's down to 2.8%.
Yeah.
So what does it mean in real terms? We just heard from our TV colleagues that, do these numbers really add up? Does it make sense? So this is what we're all going to have to be guessing and maybe waiting for the next Fed meeting, but also the jobs report, because higher rates are probably going to mean a higher unemployment rate. So what is the appetite for Jay Powell and the Fed when it comes to that?
Well, that next Fed meeting is happening on May 4th. So that's what we have to look forward to then. Hey, let's bring in Liz Ann Saunders, Chief Investment Strategist at Charles Schwab. She joins us on the phone from Naples, Florida. Liz Ann, what is your big takeaways after watching Fed Chair Powell just now for the last hour and a half?
Yeah, so obviously the move they made with raising rates is not at all a surprise. I think it was the relatively optimistic assessment he gave of the economy in light of what have been, growing concerns about recession. Now, we have to keep in mind that the Fed broadly, Fed chairs specifically, haven't necessarily been the best forecasters of recessions. They're often sort of whistling past the proverbial graveyard. So, but I think that is probably the key takeaway is he doesn't see recession risk as particularly high at this point.
I mean, Liz, do you find, first of all, great to have you here. And we, you and I have talked about lots of market cycles over the, past many years. And I do wonder how you see this one, right? You've seen strains and stresses in the system. I think going back to the, we talk about the financial crisis. How do you see this market cycle? How would you describe it?
I think it's different in so many ways, not least being what, interestingly, is no longer front page news, which is the virus. And that's just really turned topsy-turvy any traditional analysis of what the business cycle looks like. The fact that most of what we're seeing in the economy, not least being inflation, is much more typical of a late cycle phenomenon. Yet if you were to just look at the calendar relative to when we went into the COVID recession, you would think we would be earlier in the cycle. We also know that the Fed has now launched off the zero bound at a point where inflation is raging and growth expectations for the first quarter are quite low and the yield curve is quite flat. So the background conditions for the Fed to start raising interest rates, this is not what you typically see. Now, whether or not that means there's a greater chance of the so-called policy mistake, I think it's easier to argue that if we're going to say the Fed has made a mistake, they may have already made it by not having gotten off the zero bound or starting to shrink the balance sheet sooner than they did. But that's sort of the ultimate counterfactual because we can't go back in time and change things.
Well, do you agree, Liz, I'm just thinking of some of the highlights from Jay Powell in a statement, but more importantly in that press conference that followed. He said all signs are that this is a strong economy, the economy likely to flourish with less accommodative policy. Do you agree with him?
Not right now. I think if you look at the fact that we have two and a half months out of 3 already kind of built into the numbers for first quarter growth, and you look at the pretty anemic forecast that a metric like Atlanta Fed GDP now has, no, we're not in a strong economy right now. In fact, there are some measures of the economy that are actually already in recession territory. If you look not so much at consumer confidence at the headline level, but if you look at the spread between expectations and the present situation, we've never been as low as this other than in recession. So I don't think the economy is particularly strong now, but I don't think it's a stretch to believe that we're sort of in some payback in the first quarter from what we saw in the fourth quarter. I don't think a recession is the easy call at this point, but is first quarter growth going to be on the weaker end of the spectrum? Yeah.
So what does concern you about where we are in this economy?
That we're not so much facing stagflation. I think maybe it's semantics, that term. If you're going to use the true definition born out of the 1970s, was inclusive of a high and rising unemployment rate, which clearly we don't have right now. What I think we're experiencing, which could persist, is counter-cyclical inflation. And that comes after last year's pro-cyclical inflation, where it was strong demand that was part of the trigger for higher prices. Now we're at the point where higher prices is starting to put downward pressure on demand and in turn downward pressure on growth. And given that, whether it's wage growth or income growth, if you look in nominal terms, it still looks very strong. If you look in real terms, much less so. And the fact that I think we were already going to have pent down demand, at least on the good side of the economy, just because I think we've sort of exhausted our demand across goods. I think we were set to see an economy slow anyway, and now we have the added big wrinkle of the invasion and the impact on food and energy prices.
Hey, Liz, just got about 25 seconds. So where do you commit new money in this environment, real quickly?
I think you want to stay close to benchmarks, use volatility to maybe rebalance a bit more frequently, and absolutely focus on quality and lowercase v value. I don't mean just buy the value indexes, but screen for reasonable value. And you can even do that in segments of the market that live in the growth indexes.
All right, going to leave it there. Great to hear your voice. Liz Ann Saunders, she's Chief Investment Strategist over at Charles Schwab, joining us on the phone from Naples, Florida. We have just a few minutes left in this Fed Thursday. How do I remember?
Wednesday.
Oh, it is Wednesday.
Yeah.
That's right. Fed meetings are usually Wednesday. I'm like, wait, maybe I messed this up. It's that kind of a week. That's what happens when you take a day off. Nonetheless, we've got equities pretty much at their highs of the session, certainly seeing a rally when it comes to the S&P and the NASDAQ. We're getting ready for our cross-platform coverage. We call it Beyond the Bell with our TV, radio.
Beyond the Bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close starts right now.
And right now, we are 2 minutes away from the end of the trading day. Romaine Bostic, Taylor Rig, Shanali Bassick in for Caroline Hyde. We're counting you down to that closing bell here on this Fed Wednesday, here to help take us beyond the bell. It's our global simulcast with Carol Massar and Tim Stenovic. We welcome in our audience across Bloomberg Television, radio, and YouTube. And Carol, a lot of people came into today expecting Jay Powell to telegraph the number of rate hikes that he was going to give us this year. And, well, it looks like the market got it right. We got one today, and he said we're probably going to get about 6 more going forward.
Every meeting is a live one. And what's interesting is here we are, in terms of the equity trade, pretty much at our best levels of the session, especially on the S&P and the NASDAQ. So despite that initial sell-off following that Fed meeting and maybe some concerns about maybe a hawkish Fed, can I even say that? We've bounced off of those lows, Tim.
Yeah, it did seem like equity investors, and look, I know today is all about the bond market, and Taylor's going to get to that, but it was remarkable to see the pullback in equities.
Every day is about the bond market.
I know, it is, especially in Taylor's world. But look, the smart money, that's absolutely true. But look what happened to equities today. I mean, it's absolutely remarkable to see him bounce back like this on those strong comments about the economy. But I got to tell you, we just talked to Liz Ann Saunders at Charles Schwab, who said, hey, I don't think the economy is as strong as Fed Chair Powell is making it out to be.
I don't think anybody does.
I wasn't going to call you out on the bond market, Tim. I was just going to let Romaine do that for me. Let's take quickly look at this bond market.
Good cop, bad cop, Tim.
Yeah, it's like this game we play so that I always look good, Tim. You take a look, though, I mean, pretty incredible, Romaine. We talked a lot about the front end. At one point, we had the 5s, 10s, and the 7s, 10s inverted. Some of that is unwound, but it is a pretty flat yield curve if you think about just 24 basis points here on the 2s, 10s.
All right, a 2% gain in the S&P 500 on Tuesday. Well, a 2.2% gain on the S&P 500 on this Wednesday, up about 95, 96 points here on the day as we get the closing bells in New York. The Dow Jones Industrial Average also going to finish higher here for another day, up 519 points or about 1.6%. The Russell 2000, a great day. Up 61, 70, 62 points, up about 3% on the day. But let's take a look at the NASDAQ here. I want to point out the NASDAQ composite right now is up 3.8% on a daily basis here. Remember, it rose about 3% yesterday. The NASDAQ 100 also up about 3.7%. You combine yesterday's 3% gains, we're up 7% here over a 2-day basis. This is going to be the strongest 2-day gain that we've seen for the tech stocks going back to November of last year.
I think I could beat that.
Of 2020, I'm sorry.
I think
of 2020.
I'm just going to say I think I can beat that.
Can you beat that?
Yeah, NASDAQ Golden Dragon China. You ask why I always talk about it. Oh, come on.
How did I get that wrong? I knew you.
I don't know, just not your day today.
What is it, up like 50%?
Anyway,
today?
the NASDAQ Golden Dragon China up almost 33%. We know Chinese stocks rallied in China, in Hong Kong overnight. The government coming out and basically saying we're going to do whatever we need to shore up the financial markets. It's just a reminder, though, that the markets are kind of at the whim of the government, the good and the bad and the ugly, too.
Certainly. Carol, you know, it's interesting. You mentioned that you were speaking with a guest earlier on radio. We were also speaking with Mira Pandit over at JP Morgan. She said, everyone take a sigh of relief because tomorrow might actually be the real days. You think about today and sort of the one-day moves that we see sort of seems happy right now. If you're along the market, it's green on the screen, but we have to remember this is just a one-day reaction. But this one-day reaction looks pretty broad-based when you think about sort of the gains that we've seen and sort of this risk on sentiment, Carol, right? Semiconductors, auto components, banks. I mean, you think about sort of this reflationary theme underway, at least on on the front end of the curve, you're up 3 to maybe even 5% on some of the best individual sectors on the day. You come down to the bottom, there's only about 3 sectors in the red today, but they're utilities, it's food and staples, and it's energy. Now, this is interesting because energy is now lower here for about 3 straight days. You wonder if some of these inflationary assets like those food and staples also coming down just a little bit, Carol.
Yeah, you know, it reminds me that when you do have the Fed raising rates, right, the equity market tends to do well, and we're certainly seeing that play out today. All right, as for the gainers today, I got to go back to those Chinese stocks. They were top in the NASDAQ 100. PDD is up about 56% here, so pretty much closing at its highs. I did see a headline, too, that Alibaba having its biggest gain since 2014. It was up 37%.
And the Pinduoduo game, that's its biggest ever. It's debuted here.
Unbelievable. It's still down more than about 30%, though. Just a little perspective there. Starbucks, certainly a standout. Tim was like, you got to do this as a gainer. It's up more than 5% today. Howard Schultz, back for a third time as CEO, as the company's current CEO, Kevin Johnson, is retiring. So that's kind of interesting. And Land's End, I'm going to point it out because I caught up with the CEO earlier today. It's up about 13.5%. That despite earlier hitting a 52-week low and some misses for the fourth quarter and also its outlook. But nonetheless, the CEO expecting the second half of the year going to look better.
Do you think Howard Schultz saw Tom Brady and was like, I want to unretire too? Again, this is the third time. It's pretty remarkable. Hey, let's go over the decliners, some of the decliners that we saw today. Shares of Lockheed Martin falling after Bloomberg reporting that the Pentagon is going to request fewer of those stealth F-35s from Lockheed Martin than previously planned. That's according to people familiar with the plans. Shares down about 6% today. And then Norton LifeLock falling 13.2%. This after the company's proposed purchase of Avast hitting a snag in the UK. UK regulators surprising investors with a warning that their proposed takeover risks reducing competition for cybersecurity software. And here's an interesting one. CF Industries, the fertilizer manufacturer and distributor, falling 7% today. Russia's invasion of Ukraine sparking sanctions against the country. We've actually seen CF Industries higher significantly this year, especially since the invasion of Ukraine, but actually down on the news that the two countries are actually talking.
You know, Tim, it's just a bond world and you're just living in it. Let's take a look at where we're on the day. And I think what's interesting is days like today, we're really focused on the front end of the yield curve, right? And earlier we had gotten as high as maybe 198, 199. Carol, we settle out at a 192, but I think what's significant is you're still higher by about 7 basis points on the day. You have a 5-year yield that's migrated northward to a 216. From what I can see, I think that the 5s, 10s is still about 1 basis point in terms of steepness, but you do have an inverted 7s, 10s yield curve by about 3 basis points and a flatter if you go longer out on a 5s, 10s, just positive by about 1 basis point or so. And a 2s, 10s, you're still at about 25 basis points. You're not really getting that inversion, but you're really noticing sort of this bigger lift on the front end. And that's really where we're sort of signaling, as you mentioned, Carol, these sort of sequential rate hikes that the market is now expecting.
Yeah, absolutely. All right. So the Fed largely doing what we expected it to do, moving up those inflation forecasts this year, moving down growth forecasts. Bottom line, the Fed chief, Jay Powell, saying that basically he and the FOMC said the timing was right for the moves and the projections. Check it out.
It's clearly time to raise interest rates and begin the balance sheet shrinkage. And I just wanted to say that as I looked around the table at today's meeting, I saw a committee that's acutely aware of the need to return the economy to price stability and determined to use our tools to do exactly that.
All right, so of course, that's Jay Powell of the Federal Reserve. He says that they do have the tools that they need to really manage this. Do you guys agree, Romaine?
Yeah, well, I mean, I'm not going to get into whether I agree, but I do think it's interesting.
Why not?
Well, I do think it's interesting that he would use that word, the idea of looking around the table, and they're all in agreement on that, because I think when you look at the dot plot, it's very clear they're not really on agreement longer term. I think they sort of have a good starting point here, but the fact that there was a discussion, at least he alluded to it, a discussion about balance sheet runoff, but they weren't prepared to announce one today. That's huge. I also thought it was interesting, and Taylor, you brought this to my attention a little bit earlier, his comments toward the end about if they had known then what they know now. rates
Yeah.
would be a lot higher today.
And saying that, of course, we don't have the benefit, right, of hindsight being 2020. But if you had known, again, that inflation wasn't as transitory, maybe we would have moved faster. That comment certainly struck out to me. And Sonali, sort of coming back to the balance sheet as well, saying that a balance sheet reduction actually could signal or replace a rate hike. So we think about 6 sequential rate hikes, but also if you think about balance sheet reduction, is that technically sort of a rate hike? Jay Powell had alluded to
And
that.
what does it mean for a liquidity, right? Because at the end of the day, the distortions that may be caused by that balance sheet reduction is really something that a lot of people are factoring in the market. And to the point that you were making, Carol, do we believe whether they have control over inflation? There's a lot of concern still about a lot of those supply shocks that are looming out there in the market. So clearly, that is something that investors are taking into consideration and not yet convinced.
I did think that Powell's comments about balance sheet reduction and really refusing to get into the kind of the nitty gritty of the discussion and saying, check out those meeting minutes in a few weeks because they're going to have details in there. That was a real deep tease for what that's actually going to look like. And I anticipate that you could see some serious reaction to that.
He should go work at Netflix, do one of those shows over there. In all seriousness, though, I mean, on that same topic, though, there's a big debate, and this goes to your question too, Carol, about whether I think they have the tools. There's a big debate here that maybe the balance sheet is actually a better tool right now in controlling inflation rather than just trying to do it with the lever of interest rates.
I guess what's interesting too, and Tom Keene talked about that they're going to be watching for that next jobs report because we've talked about higher rates mean you're going to get a higher unemployment rate. So what does that do for growth? What does that do for sentiment? And does that really become a drag on growth? So there's still a lot to, I guess, keep an eye on, guys.
A lot to keep an eye on.
All right. All right, we got to run. All right, that's going to do it for our cross-platform coverage on radio, on TV, and YouTube. It is Beyond the Bell. We will see you again, same time, same place, tomorrow.
You're listening to Bloomberg Business Week with Carol Messer and Bloomberg Quick Takes Tim Stenovic on Bloomberg Radio.
All right, so there we have it. 2 meetings in when it comes to the Federal Reserve. And there we have it.
Yeah, we do. A really interesting comment from Romaine at the end there about the debate between whether interest rates are the right tool to use when you're thinking about actually tamping down inflation or balance sheet reduction. And we don't know the answer to that, but he did say.
Wait, what did you say?
Balance sheet reduction versus raising interest rates. And what's the right tool to actually tamp down inflation?
Well,
and he did make a comment that, we could see, X number of rate hikes this year, but we could also see a faster unwinding of the balance sheet and at a different time in the cycle than we're used to.
Right, and what they said on the balance sheet is what was the phrase that they said? They didn't give an exact, in terms of when they're going to do it, but they're going to consider it or start talking.
Okay, traders, let's move our stop to 1%. For Bitcoin, it's 40,683.
Saying that he
40,683. 1%.
addressed members of Congress virtually.
Please
asked for the West to enforce
copy this straight. All of you who started with me this morning and
the Ukrainian sky
purchased Bitcoin at about around 11 o'clock.
Thousands of people.
We already in profit.
What they felt with Pearl Harbor.
So, but we didn't sell yet, and we don't need to sell because we're nicely moving higher. So we moved to 1%. Okay, in our case, we have already 1,000 pounds. In your case, it's all about how much you invested. Okay, look, it's moving in higher. Okay, let's see.
The American people are answering President Zelensky's call for more help, more weapons for Ukraine to defend itself, to fight Russian aggression. And that's what we're doing. An additional $800 million in assistance.
The shipments, the president said, would include anti-aircraft weapons with longer-range systems in the pipeline, thousands more anti-tank weapons, and a resupply of ammunition.
We will move to 2%. 41,086.
The streaming company announced in a blog post today.
Just right here.
Feature that would allow customers to share their accounts with
41,086.
The test is being rolled out in Costa Rica, Peru, and Chile. Global News 24 hours a day on air and on Bloomberg Quick Take.
Okay, just right here. Please move your stop to this level. It will be 2%. We don't want to hold. We hold we have really large position on Bitcoin, so we need to
in New York City. So
close this trade and get as much profit as possible. Okay, so we're trying to sell it today if we will be able.
Okay,
so
the
we will collect the profit.
Twitter quote
Okay.
US and it's back.
And
Once
I
again
will
available on Netflix
increase
in the US. The series ran starting in 2015. It ran to 2019.
Let's go 40,000.
Everybody knows about this, right?
I know.
Right? Okay.
We've made reference,
he
right?
unexpectedly becomes president of Ukraine after a video
And
about corruption. It goes viral.
280
Actor, former comedian. He turned to entertainment after getting a law degree from Kyiv Economic
plus 3% will give 488.
in a huge landslide.
Unfortunately,
and 2.5.
The Russian invasion and war in Ukraine. There's a lot of things that have come to light, unfortunately, and that is
okay. Let's stick to 2%. Okay, guys, and it's not the end. Stay with me, and we will see how far it will go from this level. Okay, guys, I'll speak to you later.
Also, its leader, which I think people have always heard a tagline, former comedian, now president, but now we're seeing him, unfortunately, in action because of what's going on and wanting to know more about him.
We are Maria Tadeo from Bloomberg News on Bloomberg Television a little earlier in the day, speaking to our team following President Zelensky's impassioned plea to U.S. lawmakers. And she made the comment that he's somebody who has a background in acting and he really knows how to steal the show. And I think a lot of people would say he's really risen to the moment right now. And you see that with approval polls from people within Ukraine. His approval levels were much lower before the war and the invasion, and they've risen significantly.
With a situation where media is all cut off, when he is able to have some kind of conversation with the rest of the world, we're sitting up and taking notice, and rightfully so. All right, you're listening to Bloomberg Radio.
markets, headlines, and breaking news 24 hours a day at Bloomberg.com, the Bloomberg Business app, and at Bloomberg Quick Take. This is a Bloomberg Business Flash.
From Bloomberg World headquarters, I'm Charlie Pellet. A move higher for the Dow, the S&P, and NASDAQ. In fact, stocks closed at or near session highs after Fed Chair Jay Powell struck a more positive tone on the prospects for economic growth as the central bank raised rates for the first time since 2018. Bonds retreated. The S&P 500 posted its biggest two-day rally since April of 2020. S&P up today by 95 points, now at 4,357, a gain there of 2.2%. We've got the Dow Jones Industrial Average up 518 points today, up 1.5%. NASDAQ rallied 487 points, up 3.8%. NASDAQ 100 index up today by 3.7%. Tenured on 8/30 seconds, 10-year yield 2.17%. Spot gold up 0.5%, 19.26 the ounce. West Texas Intermediate crude down another 1.5%, 94.96 a barrel. Just getting word from the retailer Williams-Sonoma. It is authorizing $1.5 billion of share buybacks. I'm Charlie Pellet. That is a Bloomberg Business Flash.
All right, Charlie, thank you so much. Well, he's a former UK Deputy Prime Minister. He is now Meta's President of Global Affairs. New to that job, although he's been at the company for a few years. He is also the one dealing with the latest crisis at the company, and that is to solve Meta's Russia problem. The story in the upcoming issue of Business Week.
We're talking about none other than Nick Clegg, not Mark Zuckerberg, not Sheryl Sandberg, but the man charged with navigating the global political crises. Kurt Wagner is technology reporter at Bloomberg News. He joins us on the phone from San Francisco. Kurt's story is featured in the upcoming issue of Business Week magazine. Check it out, though, now on the Bloomberg terminal, also at Bloomberg.com/businessweek. Okay, Kurt, for people who don't follow Facebook as closely, Meta Platforms Inc., excuse me, I keep doing that, as closely as you have for so many years, who is Nick Clegg?
Yeah, Nick Clegg is basically the head of all policy at Facebook. So anytime you think about misinformation, you think about relationships with governments, speech, right? Like what's allowed on Facebook and Instagram, what's not. These are policy decisions. And now all of those roll up to Nick Clegg. And he is kind of the final word on what Facebook and Meta do in those instances. And obviously that's a lot of different things, especially as we get ramping up here on another U.S. election. You can imagine that all of these decisions are pretty consequential, and he's now the guy in charge of all that.
All right, what's up with Sheryl and Zuck?
Yeah, well, they're still there, for those wondering, and this has always been a kind of two-headed monster at Facebook, right? It was Mark Zuckerberg handling the product and Sheryl Sandberg handling the business, but then after the 2016 election, all of these policy issues I was just talking about really reared their head for kind of the first time. And so they took off. Like Sheryl kind of started addressing a lot of this. Mark obviously got much more involved. We started hearing from him on all these different issues around politics and policy. And over the last, couple of years, what they've realized is, one, neither of them are necessarily something that they want to do. This is not a job that's very fun. And number two, they've become so unpopular in a lot of ways that their message, Facebook's message, is often getting lost simply because of who's delivering it, right? So anytime Mark Zuckerberg says something, people have a strong opinion about him, regardless of what he's saying. And I think part of that is why Nick Clegg is now the face of all this stuff.
So how did this come into sharp relief? Look, not just during the Trump administration, because I think that was a name that Nick Clegg was a name that people became familiar with then, even if they weren't following British politics before. But with Russia's invasion of Ukraine in late February, how has it all come to a head?
Yeah, so the timing is pretty incredible, really. Meta promoted Nick Clegg on, I believe it was February 16th, so just a month ago to the day. And at that point, Mark Zuckerberg said, hey, he's the last word on all of these big things. If you have an issue, take it to Nick. About a week later, Russia invades Ukraine. And suddenly, here's Nick 1 week into his new fancy job. And, he's back channeling with the Ukrainian President Zelensky and his staff. He's talking with Russian regulators, trying to kind of navigate this whole thing in a first big challenge that happens immediately after he gets this promotion. And so the story really kind of looks at how these first couple weeks have gone for him. We actually got a chance to sit down and interview him for this. It was his first interview since getting that promotion. And, I just think it was kind of a timely look at who this guy is and why he suddenly has, one of the most important jobs in tech.
So help me out here, Kurt, because in your story you write Meta's critics called the announcement when he was named little more than a public relations move. Yet at the same time you say that he's the one who's been, Nick Clegg has been talking to Russian officials. He's the one who has talked with President Zelensky. So I don't know. How do you see it?
Well, I don't think that it's just a PR thing. I think he truly is making a lot of these decisions. And it was actually a question that I got to ask him. I brought up that criticism. I said, what would you say to people who, argue you just got promoted to be someone to take all the heat off of your bosses, And he said, look, if I wasn't actually wielding any power internally, if I didn't actually have any control over the things that I had to go out and then defend, then yeah, this wouldn't be a very good job, and it's not one that I would have accepted. But he says, he's willing to take that heat because he's the one making these decisions. And as a former politician, he's not, unfamiliar with people being angry at him no matter what he does.
Yeah, it's not a job for everyone, obviously. But it is, if you think about it, and that's why you see so many people who've worked in politics take on these policy type positions. Help us think forward beyond Ukraine, beyond Russia's invasion of Ukraine and the challenges that Clegg has in front of him when it comes to regulators in the United States and in Europe.
Yeah, of course. Well, there's some data transfer regulations happening in Europe right now, or discussions, I should say, around data transfer that's very important and that Facebook has been vocal about. I think the election here in the U.S., of course, midterms are coming up, and they're going to be dealing with all of the same issues that they dealt with in 2020, right? How do they want to handle fact-checking political posts? How do they want to handle advertisements from candidates, right? These are all the issues that haven't gone away in the last couple of years. And so he'll be looking at those. And then I think one of the biggest ones is that in January of next year, former President Donald Trump's 2-year ban will be lifted, right? And suddenly you have President Trump back on the platform, and that's going to, I imagine, create, a lot more issues for Facebook. It certainly has in the past.
Well, and as you said, Clegg played a critical role in removing Donald Trump from that platform. All right, Kurt Wagner, great stuff. Technology reporter at Bloomberg News. This story in the new issue of Bloomberg Business Week magazine, online and on the Bloomberg terminal. Catch it all now online and catch the magazine. It'll be out tomorrow. This is Bloomberg.
Broadcasting live from the Bloomberg Interactive Broker Studio in New York. Bloomberg 1130 to Washington, D.C. Bloomberg 99.1 to Boston. Bloomberg 106.1 to San Francisco. Bloomberg 960 to the country. Sirius XM Channel 119. And around the globe, the Bloomberg Business app and BloombergRadio.com. This is Bloomberg Business Week.
I have to say, when I saw him on our rundown, I was like, score. I cannot wait to talk with Tiff Roberts again.
Yeah, he's a former Bloomberg Business Week China bureau chief. He's the author of The Myth of Chinese Capitalism, The Worker, the Factory, and the Future of the World. I've seen him speak live. You used to work with him, and he's been on our show before.
He was here before my time, maybe?
Maybe you just weren't in China.
Or we didn't own Business Week? I don't know. We'll figure it out. But anyway, we're going to talk all things China because there's so many headlines. In the meantime, let's get back to your top business stories, of course. On this Fed Wednesday, check in with Charlie Pellet.
Hi, thank you very much. And what a day on Wall Street. The Dow, the S&P, NASDAQ all advancing. S&P 500, by the way, posted its biggest two-day rally since April of 2020. Stocks closed at session highs after Fed Chair Jay Powell struck a more positive tone on the prospects for economic growth as the central bank raised interest rates for the first time since 2018. Powell also addressed the Russian invasion of Ukraine.
As we noted in our policy statement, the implications of Russia's invasion of Ukraine for the U.S. economy are highly uncertain. In addition to the direct effects from higher global oil and commodity prices, the invasion and related events may restrain economic activity abroad and further disrupt supply chains.
As for the U.S. economic outlook, Liz Ann Saunders is chief investment strategist at Charles Schwab, and she was our guest right here on Bloomberg Business Week.
I don't think the economy is particularly strong now, but I don't think it's a stretch to believe that we're sort of in some payback in the first quarter from what we saw in the fourth quarter. I don't think a recession is the easy call at this point, but is first quarter growth going to be on the weaker end of the spectrum? Yeah.
10-year yield, 2.18%. S&P up today by 95 points, up 2.2%. The Dow up 518, up 1.5%. NASDAQ, perhaps the big story today, surging 3.8%. NASDAQ 100 index up by 3.7%. Russell 2000 up by 3.1%. Spot gold up 0.4%, 19.24 the ounce. A retreat for crude oil today, down 1.7%, 94.75 a barrel. Great news for airlines. Those stocks rallied today. UAL, for example, up 7.7%. American was up 5.8%. Delta up 5.9%. Southwest up 2.5%. JetBlue up by 6.7%. I'm Charlie Pellet. That is a Bloomberg Business Flash.
All right, Charlie, thank you so much. So I mentioned the rally in Chinese stocks, the ADRs here in the U.S. as measured by the Golden Dragon China Index up 33%. We saw stocks in China and Hong Kong rally overnight. This as China made a strong vow to shore up battered financial markets. So that's going on. Quite a turnaround in Chinese stocks. They've been under pressure because of greater regulatory oversight. And then there's concerns about China's relationship with Russia, how that might impact growth, the possibility of sanctions against Chinese companies, just a lot going on that's put pressure on China in general.
Yeah, that's why we're so grateful to have Dexter Tiff Roberts join us. He's a senior fellow for the Mansfield Center at the University of Montana, also senior fellow at the Atlantic Council's Asia Society Initiative, also a former Bloomberg Business Week China bureau chief, and the author of The Myth of Chinese Capitalism, The Worker, the Factory, and the Future of the World. Tiff, how are you?
I'm doing well. Great to be back on the show with you and Carol.
Yeah, really great to have you back with us.
I apologize because I forgot you were here. I've been here for a long time. I think you were overseas a lot, so I couldn't remember.
But I was in Beijing more often than New York, Carol.
Okay, yeah. Fair enough.
But I feel like you do know everybody, Carol. So, yeah, you know. Hey, Tiff, I do want to start with what Carol said about Chinese stocks, okay? Because this is a story that we've been following for more than a year now, very closely, as Chinese stocks have been absolutely getting beat up. And I'm wondering if you were surprised at all at the last minute that you saw the Chinese government step in and say they were going to offer support.
Well, I'm not really surprised because, as you said, it's been almost a bloodbath for Chinese stocks in Hong Kong, in Shanghai, and I think they became concerned. So Xi Jinping's right-hand economic person, Liu He, he met with top finance officials and basically said it's time to market stability is what we need to focus on now, and promised to ease up on the regulatory pressure that's been on the tech stocks, that's brought down so many of them in terms of their value. So I wasn't that surprised. I guess the question is how long or how sustained will this rally be? I think there are continuing issues, particularly on the regulatory side. I don't think China's backing away from its desire to deal with what they perceive as national security concerns related to online data, which many of the companies that have been hit very hard have been in one way or another involved in that business.
Tiff, is China at all starting to back away from its relationship with Russia too? Because that has also been something we all are watching very, very closely.
I think that China wants to signal to us that it's backing away from its relationship with Russia. I think they are disturbed by how long this war has been going on. They're definitely disturbed by the degree to which their international reputation has taken a beating for this perceived support and this real support for Russia during the invasion and the war. So I think that's the message that they're trying to put out, that they are actually stepping back. I'm not so sure, for a whole variety of reasons, that they're going to actually just create real distance between them and Russia.
What would real distance look like? And I mean, could China actually afford to do it, especially if Russia is so cut off from the rest of the world that China is really the only country that can supply it with higher end technology?
Yeah, I mean, I think for China, I mean, the trade relationship, you look at the Russian trade relationship, I think it's about $147 billion last year. For Russia, it matters a whole lot. China's their number one trading partner. For China, not so much. I think it's about 2% of China's trade. That compares to roughly 13% each for the U.S. and the EU. So the relationship, the economic relationship, is far less important to China. I think I think what we're dealing really with here are political issues, and that's where the alignment between the two countries becomes very, very important.
Well, it's very clear, right? And I know we've talked about this with you. We've just got about 30 seconds or so, and then we'll come back and talk some more. But I mean, China's increasingly drawing that line in the sand about how it feels about democracy and U.S. dominance, whether it's through the dollar or something else. Just quickly.
Absolutely. Yeah, no, I think the big issue here is China feels like its political values are roughly aligned with Russia. And much of that is defined by opposing the values of the U.S. and Western liberal democracy. They see that as really anathema to what they're trying to achieve.
All right, we're going to continue our conversation. We're going to get back to Tiff Roberts, Senior Fellow for the Mansfield Center at the University of Montana and Senior Fellow at the Atlantic Council's Asia Security Initiative. We've talked to him before, too, about his book, The Myth of Chinese Capitalism, The Work of the Factory, and the Future of the World. But it does feel like we've talked about the geopolitical new world order. Feels like it's being drawn right now.
Yeah, certainly much more to come when it comes to Dexter Tiff Roberts. First, though, let's head to Washington, D.C. for a check of the latest world and national news. Nancy Lyons is standing by. Hey, Nance.
Thanks, Tim. Ukrainian President Volodymyr Zelensky is pleading with the U.S. to help his country defend itself from Russian forces. He delivered an emotional virtual address to a joint session of Congress, asking for the West to enforce a no-fly zone over his country. He also had a message for President Biden.
The President Biden, you are the leader of the nation, of your great nation. I wish you to be the leader of the world. Being the leader of the world means to be the leader of peace.
Zelensky says Russia has turned the Ukrainian sky into a source of death for thousands, drawing parallels with what Americans must have felt when Pearl Harbor was bombed and planes flew into buildings on 9/11. President Biden spoke following Zelensky's request and said he is signing a new $800 million aid package that will include weapons and drones.
At the request of President Zelensky, we have identified and are helping Ukraine acquire additional longer-range anti-aircraft systems and the munitions for those systems.
Biden says the equipment the U.S. is sending should help Ukraine defend its airspace. Afghan refugees in the U.S. will be allowed to stay for at least 18 months under temporary protected status, a move that'll help some of the thousands who arrived following the American withdrawal from the country. The Afghans must already be in the U.S. and pass a background check. Homeland Security Secretary Alejandro Mayorkas says the TPS designation will help protect Afghan nationals from returning to unsafe conditions. Global news 24 hours a day, on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries.
All right, Nance, thank you so much. So Starbucks was one of my gainers today. It popped up thanks to you. You're like, what? You're not doing Starbucks?
I just love this story.
I sent around my list, and you're like, what? No Starbucks? So I did revise
Well,
it.
investors were pretty happy with the news.
Yeah, up about 5%, up as much as 8%, but settling still with a 5% gain today.
We are, of course, talking about CEO Kevin Johnson, who's been at the company for 13 years, plans to retire next month. Chairman Emeritus Howard Schultz, you know his name. He's the guy who made Starbucks what it is today, and he's come back in the past as CEO. He did retire ultimately as chairman a few years ago. I believe it was back in 2018, Carol, is that right? 2018, 2019.
Yeah.
And really stepped away from the company, but he's back again.
Yeah.
He's like Tom Brady.
Third time's the charm,
Yeah.
apparently. What's interesting, too, I don't know if you saw this, but our own, I think it was Matthew Boyle, put out a story, and he said it's about when you have boomerang CEOs who leave and come back, that apparently, according to at least one study that has been done by the University of North Carolina's Keenan Flagler Business School, found that in general, stock performance under repeat CEOs is about 10% worse than those taking the reins for the first time. However,
except for Schultz.
His first return to the reins was good for investors. Stock rose more than 500% during his tenure from 2008 to 2017, compared with a 67% gain in the S&P 500.
Yeah, he came back at last time at a really challenging time for the company. I remember Starbucks was closing many stores in the wake of the financial crisis during the recession, and he did a lot at the company to revamp the brand.
Overstored, right?
It was overstored, and then also move into China very significantly during that time. However, this time the company is also facing some significant challenges, particularly when it comes to labor. And you might remember over the last few months, you did hear stories of Howard Schultz actually weighing in and talking to stores that were taking votes on unionizing. So they actually did bring him back in some sense, even before this.
Yeah, it's interesting. But he is credited with taking it from being kind of a local coffee shop and making it into a global company. So we will see what he will do third time around.
Interim CEO.
Interim.
Yeah. What does that mean?
I don't know. We'll see how long he stays. All right, you are listening to Bloomberg Radio.
markets, headlines, and breaking news 24 hours a day at Bloomberg.com, the Bloomberg Business app, and at Bloomberg Quick Take. This is a Bloomberg Business Flash.
From Bloomberg World Headquarters, I'm Charlie Pellet. Fed Wednesday, a move higher for the Dow, the S&P, and NASDAQ closing at session highs. S&P had its biggest two-day rally since April of 2020. Today, the S&P advanced 95 points, up 2.2%. The Dow up 518, up 1.5%. NASDAQ up 487, a gain of 3.8%. 10-year yield 2.18%. Stocks rallied after Fed Chair Jay Powell struck a more positive tone on the prospects for economic growth as the central bank raised rates for the first time since 2018. Again, 10-year yield 2.18%. Gold up 0.3%, 19.23 the ounce, and West Texas Intermediate crude was down 1.5%, 95.04 a barrel on WTI. After the closing bell, we did hear from the home builder Lennar. Shares up by about 3% after hours. Lennar is increasing its guidance on both deliveries and gross margin. I'm Charlie Pellet. That is a Bloomberg Business Flash.
All right, let's get back to, first of all, Charlie, thank you. Let's get back to Tiff Roberts, Senior Fellow at the Atlantic Council's Asia Security Initiative, Mansfield Fellow at University of Montana. His book, Myth of Chinese Capitalism. He's also a former Bloomberg Businessweek China Bureau Chief. Hey, Tiff, so who needs China more? I mean, you talked about the importance for Russia, but does Russia or the U.S. need China more? And who needs the U.S. more, Russia or China? Sorry, that's a little complicated. I need a whiteboard on that one.
The second, I'll go for the second part. China needs the U.S. more than Russia, I think. Obviously, the U.S. is, I guess it now just barely smaller trade relationship with the U.S. than with the EU, but extremely important, the source of much of China's high technology. So there's no doubt that China needs the U.S. More than Russia does. So I think so I would just point that out. And then the first part of your question is, does the U.S. maybe tell me again
who needs China more, Russia or the U.S.?
U.S. or Russia.
Yeah. Sorry, I told you it was complicated. I need a whiteboard.
I think the U.S. clearly again doesn't. China and the U.S. have a tremendously important economic and trade relationship. It's tremendously important to a lot of our biggest multinationals in the U.S. So even as even as tensions grow on the political side between the two countries, I think the U.S. will continue to put, and rightly so, a tremendous amount of importance on maintaining a strong economic and trade relationship with China, without question.
So it sounds like both ways, whether it's coming from China or from the U.S., they both really need each other. That's what it sounds like.
I think so. Now, having said that, that doesn't preclude the fact that the political relationship just keeps getting worse and worse, and I think that will continue, unfortunately. So it's a tough position for both countries. Increasing anger, outright anger and disagreement about how they look at the world, but at the same time, very tightly economically linked.
Dexter, Tiff, we haven't been able to talk to you since Russia's invasion of Ukraine. And, it really seemed like a big part of the conversation early on in this war was where China would go and how this could embolden Xi Jinping to take over Taiwan. And I'm wondering where you fall on that. If you think that what Vladimir Putin is doing and has done in Ukraine, how that leaves China and the situation in Taiwan.
Yeah, well, first of all, I think it explains to a large degree why China is being, I would call it wishy-washy on which side they want to stand behind. China knows that, first of all, China, I think, feels that they feel Putin's pain, if I can say that. They actually think that Putin is an aggrieved party here and that NATO expansion is a threat to Russia, and they sympathize with that in large part because they see a rough parallel to the U.S. and the Indo-Pacific, and particularly Taiwan. They see also a threat, obviously, there. And I would just finish by saying they would like Russia's support going forward when they eventually do decide to move more forcefully against Taiwan.
Is that just a matter of time?
I'm afraid so. I'm one of those. I don't think that Xi Jinping is a status quo sort of a guy. I think he's made it fairly clear that he would like to see Taiwan much more under China's thumb during his watch. I mean, the good news is Xi Jinping's going to be around for a long time, so they don't have to do it tomorrow or anything. But yes, I think he does want to see the relationship change dramatically.
One thing that jumped out, and I was actually off for a day, but I saw this story and I'm like, I got to send it to myself because it's just sitting with me. The Dow Jones report about Saudi Arabia in active talks with Beijing to price some of its oil sales to China in the yuan. That it's something that they've been talking about for years. And this is, I guess, according to people with the matter and so on and so forth. What's your read on that? That's pretty dramatic to me.
I think so. I mean, this is obviously all about China's long-term goals and maybe not so long-term to internationalize the yuan, the Chinese currency. And this would be a significant step. Having said that, I think we can get ahead of ourselves. I mean, if we look at, just looking at for example, SWIFT, the global provider of financial transactions, compared to the China's rival, the CIPS. I mean, there's no competition whatsoever. We're talking about, I think, something like 11,000 institutions globally processing $5 or $6 trillion a day by SWIFT, and China's doing, less than 12 trillion, I think, for the entire last year. So I think, to your question, Carol, I think it's a step forward, but there's still a long way to go. And I don't think China is capable of bailing out Russia there as sanctions tighten on that country.
Tiff, we've covered a lot. We've covered this Chinese stocks, not just Chinese stocks listed in the U.S., but those in Shanghai and Hong Kong. We've covered the Russian invasion of Ukraine. I want to talk a little bit about trade between the U.S. and China, because during the Trump administration, we'd call this a trade war. And that's something that I think has been really lost in recent years with the coronavirus pandemic here. Give us an update on what you think we need to be watching for when it comes to trade between the U.S. and China, and how things actually get better from here.
Well, I think the tensions are still there. The trade war may go away. And by the way, the phase one deal signed by the previous Trump administration went nowhere, as you know. So China did not satisfy or meet its commitments on that phase one trade deal. So we still have a lopsided trade relationship. We had news just about a week ago that the Biden administration was considering levying some kind of sanctions, perhaps tariffs, related to China's continuing mercantilist practices, its industrial policy. So I think the tensions are still there. They may sort of be pushed to the side momentarily when we're dealing with, a global international crisis, as we are with the Russian war against Ukraine. But I think it's still there. I don't see that really getting much better.
All right, we got to run. Tiff, thank you so much. Really appreciate it. Tiff Roberts, Senior Fellow at the Atlantic Council's Asia Security Initiative, Mansfield Fellow at University of Montana, former Bloomberg Businessweek China Bureau Chief, and of course, check out his book. It's very relevant to all of these discussions, The Myths of Chinese Capitalism. Fed Wednesday, this March meeting. We've been looking forward to it. We got it. And got a lot of what we thought we would get in terms of a quarter-point rate hike. But Jay Powell of the Fed is striking a more positive tone, and we had stocks finishing at their highs.
But watch the markets tomorrow, as Taylor reminded us, as investors continue to digest what they heard from Fed Chair Powell.
One day does not make a trend? Is that what we're saying?
I think so.
Thursday, just around the corner. Folks, for Tim Stanovic and the whole BEW team, have a good and safe evening. This is Bloomberg.
Okay, traders, I have to close right now because the end of trading day. The streaming, what I'm going to do with Bitcoin, I'm going to hold overnight. As you can see, within close position. If you follow trades, you can close at the best price the broker will offer you. In our case, because we are professional traders, we have to place order to sell position on level 2. So we still holding 2% up for Bitcoin. We will see what's going to happen overnight. If it will close in the morning, I will show you how much we made a profit. If it will not, tomorrow we will go further. If it will move higher, we will just increase our stop for Bitcoin. Okay, guys, stay safe. Have a great evening, and I hope I'll see you tomorrow. Okay, bye-bye.